Hey there, ambitious entrepreneurs! Welcome to today's deep dive into a game-changing strategy for new LLCs produced by the Smart Money Mindset channel. We're about to uncover how you can secure up to $250,000 in business funding without the traditional hurdles. In this video, we are going to explore different funding options for business owners with both good and bad credit. There are funding options available for both. Buckle up, because this 10-minute guide is packed with insider knowledge that could transform your business journey. Let's kick things off by clearing up a crucial misconception. Many new business owners confuse business funding with business credit. These are two distinct concepts, and understanding the difference is key to your success. Business credit typically involves establishing trade lines with suppliers. These are called Net 30 vendors. A Net 30 vendor is a supplier that allows small businesses to buy goods or services on credit, with payments due within 30 days of the purchase date. It's about building a credit profile for your business entity and obtaining a good Paydex score. On the other hand, business funding, which we're focusing on today, often relies heavily on your personal credit score and not your Paydex score. Why is this important? Because it means that even as a new LLC, you have a pathway to significant funding. Your personal financial history becomes your ticket to business capital. A middle credit score of at least 680 will get you approved in most cases. Now let's break down the $250,000 blueprint so you can be on your way to obtaining funding for your business in the next 30 days that leverages your personal credit. There are 5 major banks that are currently offering up to $50,000 in business funding for new LLCs. Here's the kicker. You don't need to show proof of income. Instead, they're looking at your personal credit to assess risk. This is a game changer for new businesses. Traditionally, lenders want to see a track record of business income, which new LLCs simply don't have. By leveraging personal credit, these banks are opening doors that were previously closed to startups. When applying for this funding, you have a powerful tool at your disposal. It's called stated income or projected income. That's right. You can state your anticipated earnings on your application without providing tax returns or bank statements. This strategy is brilliant for 2 reasons. The first reason is that it allows you to paint a picture of your business's potential. Secondly, it gives banks a basis for assessing your ability to repay the loan. Remember, be realistic but optimistic in your projections. If you state that you are projecting $10 million in revenue in 6 months, you will more than likely be declined, so keep it real. Banks understand that new businesses are speculative, but they want to see that you've done your homework and have a solid plan for growth. Now let's talk about the 5 banks you need to know about. Number 1, Chase Bank. Number 2, Bank of America. Number 3, PNC Bank. Number 4, US Bank. And last but not least, American Express Business. These institutions aren't just offering funding, they're also reporting to business credit bureaus. This dual benefit means you're not only getting capital, but also starting to build your business credit profile. It's like hitting 2 birds with 1 stone. Each of these banks has its own application process and criteria, so let's break them down. First, let's talk about Chase. With a Chase business line of credit or commercial line of credit, your business can have access to working capital when you need it. Chase Bank offers a variety of business credit cards and loans and often has promotional offers for new businesses. Credit lines can range from $5,000 to $500,000. The second source that offers stated income funding for new businesses is Bank of America. They provide tailored solutions for different business sizes and has a reputation for competitive interest rates. Bank of America have both secured and unsecured business loans for new startups. Credit lines can range from $5,000 to $250,000. The third bank that offers funding for new businesses is PNC Bank. They focus on building relationships with small businesses and offers a simplified application and decisioning process. PNC Bank also offer a mix of traditional loans and lines of credit with no collateral required and convenient repayment terms. Known for their customer service and support, PNC offer credit lines for new businesses ranging from $20,000 to $100,000. The fourth bank we will explore is US Bank. They provide a range of funding options for different business needs and often has flexible terms for new businesses. Known for their online banking tools, they also offer loan amounts from $5,000 to $250,000, competitive fixed interest rates and monthly payments. They also offer flexible terms up to 84 months, as well as secured and unsecured options, and you can easily manage your loan through their online banking portal. The fifth bank on this Fab 5 list is American Express Business. They offer both charge cards and credit cards for new businesses. What's unique about them is that American Express Business credit cards often have no preset spending limit, meaning the amount you can spend adjusts based on your usage and payment history. Some American Express Business cards include a 0% intro APR for 6 months from the date of the account opening on purchases eligible for pay over time. Now here's where the strategy gets really powerful. You're not limited to just one bank. By applying to multiple institutions, you could potentially accumulate that full $250,000, stacking the odds in your favor. Here's how you can approach this. 1. Start with the bank where you have the strongest personal relationship. 2. Space out your applications to avoid multiple hard inquiries on your credit report at once. 3. Be honest in each application about other pending applications or approvals. 4. Use each approval to strengthen your case with the next bank. Remember, while $50,000 is the potential ceiling, be prepared for the possibility of lower amounts. Banks will still assess risk, and as a new business, you might not get the maximum from each institution. So it's time to rethink a few things we have been taught concerning business funding for new businesses. There's a persistent myth in the business world that you need 2 years of operation before you can qualify for significant funding. Let's just bust that myth right now. These 5 banks are offering funding to new startup businesses, which means you can start this process as soon as your LLC is formed. There's no need to wait around watching opportunities pass by. This immediate access to capital can be the difference between a slow start and explosive growth for your business. A word of caution: understanding the limitations. While this strategy is powerful, it's important to approach it with eyes wide open. Here are a few things to keep in mind. 1. Personal liability. Since these loans are based on personal credit, you're likely to be personally liable for repayment. 2. Credit impact. Applications and new accounts will affect your personal credit score. 3. Repayment terms. Carefully review the repayment terms for each loan or credit line. 4. Interest rates. Compare the rates offered by each bank as they can vary significantly. 5. Fees. Be aware of any annual fees, especially on business credit cards. Now, after you've done your due diligence on the terms, make sure you are maximizing your funding and be smart on how and when to use your borrowed capital. Getting the funding is just the first step, however. Using it wisely is crucial for your business's success. Remember, business funding is not free money. Therefore, you should have a solid business plan in place before using or applying for this type of funding. Here are a few tips. First, prioritize revenue-generating activities. Invest in areas that will directly increase your income. Secondly, build a cash reserve. Set aside some funds for unexpected expenses or opportunities. Thirdly, invest in efficiency. Use some capital to streamline your operations and reduce long-term costs. Number 4, invest in marketing and customer acquisition. Allocate funds to grow your customer base. And last, invest in professional development. Invest in yourself and your team to improve skills and knowledge. Remember, you are building for the future, beyond the initial funding. While this $250,000 strategy is fantastic for getting started, it's also important to think long-term. Here's how to leverage this initial funding for future growth. 1. Establish a strong credit profile. Use these initial credit lines responsibly to build a solid business credit score. 2. Network with other business owners. Learn from their experiences with funding and growth. Explore additional funding sources. As your business grows, look into SBA loans, angel investors, or venture capital. We have a link in the description on how to qualify for both SBA loans and angel investor funding. 4. Reinvest profits. Use the revenue generated from this initial funding to fuel further growth. Build a comprehensive blueprint and business plan for securing significant funding for your new LLC without the usual hurdles. Let's recap the key points. Leverage your personal credit for business funding. Remember, 680 credit score or higher can qualify you in most cases. 2. Target the 5 banks offering funding to new LLCs. 3. Use projected income to strengthen your applications. 4. Apply to multiple banks to maximize your funding potential. 5. Start the process as soon as your LLC is formed. 6. Use the funding wisely to generate growth and build a strong financial foundation. Remember, this strategy is about more than just getting money. It's about setting your business up for long-term success. By combining this funding with smart business practices, you're positioning yourself for sustainable growth. Now, you may be thinking, my personal credit is not that good. So are there other options for me to get business funding with poor personal credit? The answer is yes. We have alternate funding options for business owners with low credit scores. If you are a business owner in need of funding, but you have challenged personal credit and need funding right away, qualifying for business funding just got a lot easier for you. It's called Alternative Business Funding. The qualifications for this type of business funding are far simpler than getting approved by the big banks. So, let's see if you qualify. All you need to qualify is be in business at least 4 months. Prove that your business generates at least $10,000 in monthly revenue. You only need a 500 or higher personal credit score, and last, but not least, your business must be based in the USA or Canada. That's it. No collateral needed, no high credit score required, and no 2-year business history needed. Also, the process is lightning fast. You can be approved in 24 to 48 hours or less. Now let's review the 3 types of funding that are available. The first one is called Instant Microfunding. Our Instant Microfunding option gives you access to $500 to $10,000 right when you need it. This is a one-time instant funding, with the option to apply for more down the road. Funding amounts range from $500 to $10,000 with repayment terms between 3 to 6 months and manageable repayment options. The second alternative funding option is called Revenue-Based Funding. Let's review how it works. Revenue-based funding is a flexible financing option designed to help small businesses get the cash they need without the strict qualifications or rigid repayment terms that come with traditional banks. With revenue-based funding, the amount a business can borrow is directly tied to its monthly revenue. Approved businesses receive a one-time lump sum of cash, ranging from $10,000 up to $2 million, depending on their revenue. This can be used for a wide range of needs like inventory, payroll, marketing, or expansion. Unlike a traditional loan with fixed monthly payments, revenue-based funding has flexible repayment terms that fit the business's cash flow. Repayment schedules are flexible with monthly, weekly, or daily options. This ensures that repayments are more manageable, especially if revenue fluctuates. The third and final alternative funding type is a business line of credit. This type of credit line is specifically tailored to business owners who don't qualify for conventional loans. A business line of credit can get cash in your business bank account quickly if you need access to funds for any reason. This type of line of credit gives you a revolving credit line you can draw from 24 hours a day and 7 days a week. You only pay back for what you borrow. Credit limits range from $6,000 to $100,000 with flexible repayment terms that range from 6 to 24 months. You only pay interest on the amount you use. Use the link in the description to learn more about these alternative funding options for business owners with low credit scores. We also have links in the description that will help you build both your personal and business credit. Hit that like button if you found this guide helpful. And don't forget to subscribe and share this video with other business owners for more in-depth business strategies. Until next time, keep dreaming big and working hard. Your business success story starts now.